Okay, here we have the 1-3 work together. Now, instead of just having columns for assets and liabilities, we're going to have specific account columns to put our plus and minus signs in. So our first transaction received cash from sales. So you see, instead of just marking asset, we've got different accounts underneath the assets title. So we have an increase in cash. So we'll put a plus sign there. The business received that cash from a sale. Sales count under owner's equity. So now the business has received cash. So that's an increase in value for owner's equity. And now we have our second one, sold services on account. So the business sold some services that are going to be paid back to the business at a later date by this Harmon company. So that's money that's to be received. So that's going to be called an accounts receivable. Any money that's due to be received it goes under accounts receivable. So that's an AR account. So the amount of the sale, sold services, whatever that amount is, that has increased the amount that Harmon Company now owes the business. So the amount that they owe has increased. So that's a plus sign. And just like the first one, this is a sale. This is sold services. So any sale, that's going to go under owner's equity. So we have a sale, so that increases owner's equity. And one of the reasons why this is considered still an asset, even though it hasn't technically been received yet, say hypothetically, if that asset never actually that bill never gets collected, that account can be sold to a debt collection agency for something. What, like pennies on the dollar. Is not the company's not going to receive the whole value for whatever's owed, but it can be sold off to a collection agency and still get something for it. So that's why it's still considered it. That's why it's going to be considered an asset, even if it doesn't get paid. So there's some value there still. Okay, so now the third one, paid cash for cell phone bill. So we paid out cash. We'll put a minus sign for cash. That decreases the value of the business. And that wasn't a paid on account. That was just a straight up paid utility bill. So it's an expense. Those expenses also go under owner's equity, since that decreases the value of the business by paying out that cash. We have the minus sign for owner's equity. So our fourth transaction, received cash on account from Harmon Company. So received cash, so a plus sign because the cash goes up. And then the amount that Harmon Company owed, since they've paid some money towards that account, is going to decrease. So we'll put a minus sign. over there. And the reason why there's no change in owner's equity is because for this Harmon account, the owner's equity already got credit up here on transaction number 2. So now we're just using a cash swap for the amount that Harmon owed. See the cash, the amount that they owe goes down. No change in the value of the business. And the last one, number 5, owner withdrew equity in the form of cash. It's the owner's business, so they can take money out. So the owner takes money out of the business, so we have a decrease in the value of the cash. We had a decrease in the value of the cash, meaning there's going to be a decrease in the value of the business in general. So a minus sign for owner's equity. And that is the 1-3 work together.